Are you prepared for the Fed's next move? Are you wondering what lower interest rates might mean for you and your portfolio? If you have these questions and are hungry for clear answers, well, stick around, because in this educational video, we're going to provide specific guidance about not only the impact of the Fed lowering interest rates a full half point last month, but also specific considerations for you and your portfolio. As you're probably aware, on September 17th of this year, the Federal Reserve, or the Fed, made headlines when they reduced interest rates for the first time in 4 years. The Fed indicated that it has gained greater confidence that inflation is moderating and moving steadily towards its 2% inflation target. This rate cut reduced the Fed's benchmark interest rate a full half point from a 23-year high of 5.5% down to 5%. And it represented a significant economic milestone in the central bank's most aggressive inflation-fighting campaign since the 1980s, and also for Americans struggling with rising living costs over the past few years. It also raises many questions for investors like you. Hi, my name is Joseph Eshelman, and I'm the president of Towerpoint Wealth. We're a leading wealth management firm located in Sacramento. And unlike financial advisors who work for any of the major firms on Wall Street, at Towerpoint, we have a fiduciary obligation to our clients, and we're legally bound to act in their best interests 100% of the time. And right now, many investors are wondering if it's in their best interests to make adjustments or changes to their portfolio now that interest rates are beginning to decline. So before we understand if it makes sense to adjust your investment strategy now that rate cuts are beginning to take place, let's first take a quick look at the impact that interest rates can have on the stock market as a whole. The relationship between interest rates and the stock market has been closely studied. When the Fed announces a change in interest rates, the market usually responds. Because of this link, the Fed has historically used interest rate cuts or hikes to either bolster or manage the growth of the economy and, some argue, the financial markets. Interest rates are a tool the Federal Reserve uses to control economic growth. Historically, when the Fed seems set to announce a change in interest rates, the stock market usually responds. Higher rates make borrowing more expensive for both businesses and consumers, while lower rates do the opposite, making it cheaper to both borrow and invest. This change in borrowing costs affects everything from home mortgages to corporate expansions and, yes, even stock prices. When interest rates drop, businesses can borrow money at lower costs. This often leads to more investments in growth, expansion, or even acquisitions. As companies grow their sales and their profits, their stock prices can oftentimes rise, creating a generally inverse relationship between stock prices and interest rates. Additionally, for consumers like yourself, cheaper borrowing can mean more spending, which drives corporate revenues even higher. On the flip side, lower interest rates can sometimes lead to inflated stock prices or even asset bubbles. So importantly, as interest rates on fixed income instruments like bonds decline, stocks can become a more attractive option to investors. However, if demand for stocks becomes too high, they can also quickly become overvalued. Is your head spinning yet? Paralysis by analysis, some might say. So let's take a look at what lower interest rates might mean for you and your portfolio. Generally speaking, interest rates don't always affect every sector's stock prices the same. Historically, when interest rates drop, sectors like energy and technology tend to outperform. Tech and energy companies, especially those focused on growth, can take advantage of lower borrowing costs to fuel innovation and expansion, and are also able to refinance their debt at lower rates. All of this can lower interest expenses and free up cash flow and capital to potentially invest elsewhere. When interest rates are higher, it's more expensive for companies to borrow. That means generally less investment in growth, fewer expansions, higher interest expenses, and sometimes lower stock prices. So with interest rates coming down again, what does that mean for your investment strategy? Should you pull your money out of stocks and invest elsewhere? Or should you take advantage of lower rates to increase your exposure to the stock market? Here's the thing. Trying to successfully time the market based on rate cuts can be extremely risky and difficult. While lower rates are often seen as a positive for the stock market, it doesn't always lead to immediate gains. If the rate cut is a response to economic weakness, the market could still see some major turbulence. For example, during the 2008 financial crisis and the COVID-19 pandemic, the Fed slashed interest rates, but the stock market still experienced wild swings. That's why it's so important to consider the why behind rate cuts and not just react to the news. What should you do when the Fed cuts interest rates? Tip number 1, avoid reacting too quickly. Please don't make any knee-jerk decisions. The stock market can be volatile after a rate change, but making impulsive moves could lead to locking in losses or missing out on potential gains. Tip number 2, focus on your asset allocation. Revisit just how you're diversified. A rate cut could make certain assets, like stocks, more attractive relative to bonds, but that doesn't mean you should abandon safer investments altogether. Bonds, alternative investments, and even cash can still offer stability in a volatile market and can all play a role in a healthy and properly diversified portfolio. If you've already established a long-term asset allocation plan, good for you, but now is the time to ensure that it still aligns with your personal and financial goals as well as your overall tolerance for risk, rather than making impulsive shifts based on short-term events like a rate cut. As noted in the Financial Analyst Journal, your overall asset allocation is the single biggest determinant of your portfolio's longer-term performance. Tip number 3, diversify your portfolio properly. Please be aware how important it is to be properly diversified in your portfolio. Certain sectors like technology and energy may benefit from lower rates, but others, like real estate and consumer discretionary stocks, might struggle. Additionally, diversifying across both growth and value stocks can help you navigate the ups and downs of interest rate changes.
Are you a busy investor always on the go? Take the powerful knowledge of Towerpoint Wealth with you wherever you are with our original podcast, A Wealth of Knowledge. Now available on all major streaming platforms, and best of all, it's completely free to download and listen. Now that's an investment worth making. Click the link above and start listening today.
Tip number 4, watch out for inflation. Inflation is always there. You better keep an eye on it. Lower interest rates can oftentimes lead to inflationary pressures. So if you're worried about inflation eating away at your real return, you might want to consider inflation hedging assets like Treasury Inflation Protected Securities, or TIPS, or increasing your exposure to commodities within your portfolio. Additionally, check out our article on how to protect yourself from inflation in the description found below. Tip number 5, don't lose sight of the bigger picture. Finally, we want to remind you that the impact of interest rates on stocks, it's just one piece of the broader economic puzzle at the end of the day. While lower rates can stimulate the economy and affect stock prices, they're by no means the sole determinant of market performance. A myriad of other factors, such as corporate earnings, global economic trends, consumer and investor sentiment, and geopolitical risks, are also playing a role and can also have a significant impact on the stock market. A well-diversified, disciplined, longer-term investment strategy can help you ride out the inevitable volatility and help to keep your portfolio on track. We hope that you've enjoyed this video, that you feel better equipped, and that you've gained a greater understanding of the role that interest rates play in the stock market. While interest rate cuts can create opportunities, it's important to recognize that the stock market's reaction isn't always straightforward nor correlated to just the movements of interest rates. Usually, changes in interest rates are not enough reason to alter your longer-term investment planning and portfolio-specific decisions. So instead of making knee-jerk portfolio changes based on shorter-term market and interest rate fluctuations, we urge you to focus on your plan and maintain a properly diversified portfolio that aligns with your longer-term personal and financial goals. At Towerpoint Wealth, we are committed to providing you with resources and guidance to help you navigate economic shifts with confidence. Thank you for watching, and please click the subscribe button below for more expert financial insights. You can also read more about interest rates and their role in the stock market with the links in the description below.